Alright, my fellow financial rebels, let's get real for a minute. Many of you've been asking me, hey, 25-year-old genius finance guru, what is the secret to making bank? The big bucks, the real moolah. And I tell you the truth, but nobody ever believes me. They want a magic pill, a get-rich-quick scheme, a lottery ticket to wealth. But life, and especially money, it doesn't work like that. And today, we're going to tear down some illusions, rip off some masks, and expose the financial shenanigans happening right under our noses. So grab your favorite beverage, buckle up, because this is going to be a bumpy but brutally honest ride. First things first, you see these big, fancy corporations, right? Everyone's like, wow, they're crushing it, profits are through the roof, and you're thinking, why am I not crushing it like them? Well, let me tell you a little secret, they're doing it. And here's the kicker, they're doing it with borrowed money. That is right debt, whether you're a government, a giant corporation, or just little old you. It all works the same in the end. It is like taking out a mortgage to buy a bigger house, great for showing off, but who is paying the piper? Even those super rich tech companies, the ones swimming in cash. You remember them? Well, they've been piling on more debt too, just to keep their engines running to fund their next big thing. It is like, hey, we're rich, but let's borrow a ton more just for fun. And then we have interest rates, the silent puppet masters of the financial world. Remember, bonds, debt, all that stuff. It dances to the tune of interest rates. And I've got to show you something truly, deeply unsettling. I'm sorry, my friends, but the 2-year, the 10-year, and the 30-year yields, they've all broken out. Can you see it? It is like a financial prison break. Technically, this means interest rates are likely headed higher, way higher. Investors, they're starting to get antsy. They want more money for the risk they're taking. And this, my friends, this is not good news. Not with all that corporate debt floating around. All that old debt needs to be rolled over, and all that new debt needs to be taken on at these higher rates. It is like getting a new credit card with a higher interest rate just as your old one maxes out. This chart, the one you're looking at right now, it is probably the most important thing I'll show you today, because it is screaming that we are in deep, deep trouble. All that debt, all those free rides, the consequences are finally knocking on the door. So yeah, Wall Street might be partying like it is 1990. High-fiving over stock market gains, but this right here is an early warning signal, a flashing red light. The markets, they're not having it. The bond vigilantes are back, and they are hungry. And how does all this impact you, the everyday consumer, your feelings, your confidence? Well, inflation, right. It means you have to spend more just to keep your head above water, just to maintain that same standard of living you had last year. And at this level of inflation, where people have to borrow in 4 easy payments just to feed their families, that, my friends, that doesn't exactly make you feel confident about the future, does it? But hey, there you have it, the tale of two cities, loud and clear. And it is so obvious, because what is holding this whole shaky financial house of cards together? It is consumer confidence, a whisper, a prayer, a fleeting hope. But don't worry, look at the earnings. Those corporations, they're making more money than ever. Yes, inflation, it actually benefits them. Big surprise there. But hey, here is another shocker. U.S. inflation officially rose 3.8% in April. That is right, eroding your paychecks. Every single one of them, that is the consumer price index. That is the official inflation number. Do you really think that is real? Because I don't, not for a second. They jury-rigged things, manipulated the numbers just to make it look better. But honestly, since 2021, actually if I'm being super real about it, since 1913 by design, U.S. wages never ever keep up with inflation. Nominal wages maybe, but in real terms the average worker is losing ground, constantly. And this is incredibly important because Main Street, your street, my street, we don't live from asset appreciation. That is for the 1%ers. The financial elite, Main Street, does not. We work, we earn, we spend. So if you look at that bottom purple line, after inflation, real average hourly earnings, is it any wonder that people are suffering, struggling? When inflation rises faster than wages, living standards decline, or people take on more debt just to keep up, just to accommodate it. And to be honest with you, those inflation pressures, they seem to be escalating to me. What do you think? Here is the producer price index, the wholesale inflation numbers. These haven't trickled down to you yet. But producer prices, they matter because businesses eventually pass many of those higher costs on to us, the consumer. And don't worry, they've got to protect their profits. Right, but that means inflation pressures can keep building, simmering just beneath the surface of the economy. We can't see it yet because it is still in the producer price index that will come down eventually. But look at this. This 6% print, it has triggered a very important pattern shift. Let me show you what I mean. There you go, guys. This chart shows producer prices breaking out, just like those interest rates, breaking out to the highest level ever. This is a big deal. Because commodities, they're at the very beginning of the economic chain. You can have these paper prices until they can't anymore. Because when raw material costs rise, those higher prices, they have to move. And where do they move through? Manufacturing, transportation, food, every single aspect of the global economy. And that is why I say this is all just heating up a financial pressure cooker about to explode. But this is a very big deal because this is another breakout, and it creates even more pressures on households, on your wallet, on your peace of mind, and certainly this is all reducing your purchasing power every single day. And at the same time, higher interest rates mean that the bond vigilantes are starting to notice this inflation risk. Just like I showed you, they're sniffing around, ready to pounce. But what about the craziness happening in the gold and silver markets? Because all of you are going, oh, why isn't gold rising? Why isn't gold rising? And why isn't silver rising? Right. Well, we're looking at the spot contracts. That is the problem. But let's just take a look at this. Because a stronger than expected rise in consumer and producer prices raises concerns that the Federal Reserve may need to increase interest rates in the short term. Okay, so while I know that people watch the spot gold and silver market and think that that truly represents gold and silver, it is understandable because that is what we were taught. That is what the system wants us to believe. But like inflation, paper markets dictating the price, frankly, that is all by design as well. And they admit it. It is not me just saying it or pulling it from some airy-fairy conspiratorial site. You read when they set things up, and they admit that all of this is by design. And even though that is in the process of shifting, we've been talking about that for almost a year and a half now. Wall Street logic is this. Why would you hold gold? It doesn't pay interest. Bonds, debt, that is better. Well, gold doesn't have to pay interest because it runs no counterparty risk. Zero nada. It is the single safest thing that you can do according to the Bank for International Settlements, which is the biggest bank. It is the central banker's central bank in the world. So in theory, bonds or debt is more attractive for investors than gold and silver, because bonds pay interest. But I'd like to ask you this little question. This is my $10 trillion Zimbabwe note. If I had a bunch of this debt, and it paid me a bunch of this, can you tell me what good this would do? Because frankly, a trillion times zero is still zero. It is worthless. So let's look at what is happening on the technicals. Because these are contracts, right? Paper promises. And you can kind of see a wedge forming here. This is just a one-year contract. Now, I would like to point out to you that it is substantially higher. The silver spot contract is substantially higher today than it was just 1 year ago. And if you recall in our conversations, I said there are a few things that can happen. And one of them that is happening is that the spot silver contract is staying inside of that narrow range, giving that 200-day moving average an opportunity to catch up. But look, it is still 18% above that 200-day moving average. That doesn't mean overvalued. It does mean overbought because they can create as many contracts as they want without limitations. It is just paper. So it doesn't reflect the true fundamental value of an ounce of silver. But, last week I showed you how, during this period of volatility, some very large players are standing for delivery on those silver contracts. They want the real thing, so let's take a look at it, because that is what you're looking at. This is the 6-month silver contract. Now you can see there is a lot less silver for delivery out there, isn't there? Okay, but in the meantime, silver prices are more volatile because they are telling you that there is a major shift that is going on. A tectonic plate moving beneath the surface. Here is the technical chart on gold, the 1-year spot contract. Again, I will point out that it is substantially higher than it was. The contract is just 1 year ago, and we're still 5% above the 200-day moving average, which means that the spot gold contract is no longer overbought. But you can see how it is sitting in. It is creating that wedge, like a wedge of cheese, right? And we'll see if it breaks out above or below. A suspenseful financial thriller. And all of this is just from paper contracts, not the real stuff in both gold or silver. And remember, everywhere around the world, the global central banks are accumulating gold. This is the 6-month conch gold. Can you see that somebody's taking delivery? Somebody is taking delivery, even with the price pullback. And I can't tell you exactly what those contracts are because I didn't put that data in there. But is all of this volatility about keeping you away from buying gold because ETFs to technology demand, physical buyers? This tells us that it is a structural trend, not just a short-term trade around the world. Retail investors were drawn to gold's price momentum and safe haven appeal, driving bar and coin demand up 42% year on year. So, I want you to keep this in mind, that those paper contracts, that is one thing, but bar and coin demand up 42% year on year. That is real, tangible demand. Demand in China surged 67% year on year, considerably higher than the previous quarterly record. And by the way, do you really think these central banks are going to be honest with us about what they're really accumulating? Because other Eastern markets, including India, South Korea, Japan, also saw an increase in bar and coin buying, contributing to the ongoing structural shift in gold demand. Bar and coin demand was also supported by strong growth in the US and Europe, up 14% and 50% respectively. Can you see the difference between the contracts and the physical markets? Right? You and I are not working in the contracts because they don't mean anything. That is all counterparty risk. Paper promises that can be broken, but we live in the real world, and what you're looking at here is that bar and coin investor demand. So I want to begin with the tale of two cities. Again, we began with that, and let's just take it to conclusion today. I believe there is not one doubt in my mind that we're living through a tale of two economies. Wall Street experiences asset inflation. Woohoo, party, party. Main Street experiences life inflation, the kind that eats away at your daily budget. And what is really interesting to me in this is in my generation, we were taught to accumulate assets, to build wealth, to save for a rainy day, and frankly, those assets did me. Thank goodness. I had them. There were times in my life when if I didn't have them to sell to feed my children or other circumstances, what would I have done? But these new generations that are coming up, they've been taught to collect experiences. Well, you cannot liquidate an experience if you get into trouble. You can leverage that experience for other things. Sure, but one side of the economy benefits from using those financial assets, playing the game. The other side struggles with rising everyday costs, expenses, and that pesky inflation that impacts that declining purchasing power, your hard-earned money buying less and less, and as debt rises, inflation pressures continue, and confidence weakens more people are turning back. This happens every time.